Hello, welcome to our monthly roundtable. I'm Ermi Desai, editor here at Move Smartly. And once again, we have with us Steve Saretsky in Vancouver. He's a broker and a real estate analyst out there. Hi, Steve.
Thanks for having me on. Always fun.
And John Pasalis is here of Velocity Realty in Toronto, a broker, president, and analyst here in Toronto. Hi, John.
Hello again.
So we are in October. How are you guys feeling? What's the mood?
Sad.
It's sluggish, that's for sure. It's a tough market. Yeah.
All right. Well, let's get into that. Steve, do you want to start with just a market report on Vancouver, what you're seeing in the numbers and on the ground?
Yeah, I think the anecdotes will probably suffice more in the data because if you look at the data, it's not really any clean data sets. Like what I can tell you is you look at sales, they're up year over year. So if you look at sales, they're up 13% year over year. So most people think that's kind of confusing. We have to keep in mind September of last year was dead. It was really slow. So if you kind of zoom out, sales are running at 25% below their 20-year average. That's for all of Greater Vancouver, all property types. So it's a week. It was a weak month of September for sales. New listings are starting to normalize. They're actually were slightly above trend, and I just went dark.
Keep going.
It's that kind of market.
Yeah, new listings were same trending above long-term averages. So we're starting to see a scenario where new listings are now outpacing sales. And so I think we're starting to see downwards pressure on prices. Just anecdotally, properties aren't getting a whole lot of showings. The phones aren't ringing a whole lot. There is still the odd multiple offer because if you look at total inventory for sale, it's more or less outside of 2017 and 2020 or 2021. We're within a couple hundred units of record low inventory dating back for the last 15 to 18 years. So inventory is still very, very low, but you just have hardly the demand is so weak that at these levels of demand, it's not going to take that long for inventory to slowly start to accumulate and put downwards pressure on prices. And like I said, I would argue that we're now starting to see, over the last 6 weeks, we are starting to see prices change.
And Steve, am I right in saying that in the numbers, it's showing year over year sales up?
Yeah, year over year sales are up, I think 13% on a year over year basis. But again, if you kind of zoom out, over the last 20 years, we're still below long-term averages. It was historically a very weak September. And I don't think that should be surprising, right? I mean, I think John, we have to evolve as the data evolves. And I think at the end of the day, the reality is mortgage rates continue to push higher seemingly almost every week. And as that happens, I think we have to adjust and say, okay, what is the outlook now moving forward? And I think what we're seeing is even people that were transacting in September, or we're transacting on rate holds with a 5 in front of it. For the most part. And now as we're starting to see these rate holds expire and the new rate today is a 6 in front of it. And so what is that going to do to the October market? I think it's going to slow it even further.
So that's interesting. Thanks, Steve. So John, in the Toronto area, I did see some bulletins, maybe from outlying areas adjacent to Toronto, saying sales were up year over year. And that surprised me because across the region in Toronto, I didn't think that was the story.
Yeah, no, sales are not up year over year in Toronto. So I'm not sure who was reporting that, but sales, okay, so sales for low-rise homes. So if you think of single family, whatever, especially detached, if you look at detached, they're actually the lowest level pretty much since 96 on record that we have. So detached sales, which of course the most expensive homes, are pretty much at kind of record lows, or at least are the recorded numbers that we have. And that's causing inventory to build for low-rise homes. So we've gone from 1.5 months of inventory. We're now just under 4 months of inventory. And then sales are, new listings are somewhat average, for detached and low-rise homes. They're not crazy, but certainly listings and inventory are up. When we look at the condo market, sales are also down over last year. they're not quite as, they're still well below normal levels, but not sort of like record lows, kind of like detached. The difference with condos is the new listings are pretty much like at a record high. If we exclude 2020, which saw this massive run up in new listings for condos as people were exiting, that year aside, like new listings volumes were pretty much the highest we've seen on record outside of 2020. And new listings for condos are hitting about 5 months of inventory. Sorry, inventory is hitting about 5 months of inventory for condos as new listings are surging. I'll say prices generally are down in both. I mean, we might be down, especially for houses, probably close to 10% since May, plus or minus. And again, I think this is really just this imbalance between, the demand and the sales. Now, the one interesting thing for Toronto is that many of the stats are kind of, we'll say, worse this year than last year. Like sales are softer, inventory is higher. When I was looking at the statistics for a recent report, I was kind of surprised to find that homes this September are actually selling faster than last September. When we look at not just the days on market for the sold listing, but if we add up, the previous days on markets for properties that were relisted, and low-rise homes, more than 50% are selling within 2 weeks, pretty much, and that includes all, like if we look at all of the relistings as well, taking that into account, easily half of homes are selling within 14 days, which is faster than last year. So, homes are still moving surprisingly. I think some that are probably on the market a little bit longer are just overpriced. But it's just, I mean, to me, that was just shocking to think that we're in this sluggish market. And even condos, I mean, about 35% of condos are selling within 2 weeks. Condos are usually take a little bit longer than houses. So, but I tend to agree with Steve. I think like the sentiment is more pessimistic than last year. People are more cautious. I think it's harder to buy. So probably things are going to get cooler and we'll probably see places sit on the market longer. The one interesting thing I think with Toronto is with houses sitting on the market is everyone's so used to places selling in like a week. So, if you're like a seller and your home's on the market for 3 weeks, like some have like panic attacks, like what's going on? I'm not getting showings. It's not selling. And I think it's just going to take some sellers some time to kind of adjust to what a slower market looks like. And you're not getting 60 showings your first week. You're getting 10 or 8, and you're going to be on the market for 4 to 8 weeks. So I think it's going to take some time for people to adjust to that.
That's interesting. And a question for both you and Steve, are you seeing sellers start to adjust to this new reality or,
I think so. I think sellers, I mean, I'm finding, we're actually just talking about that. We had a sales meeting this morning. I mean, we're talking about that in our meeting. The one difference I think for this year from last year, maybe why houses are selling faster this year than last year, is that last year, I think sellers, because prices had just declined, like the highs reached in February of 2022 were still in people's minds. You know what I mean? And people, I think, were resistant because prices fell like over 20% in 2022. So I think sellers are still like resistant to reduce and still optimistic the market would rebound. You know what I mean? Whereas now I think sellers are just a little bit more realistic. I don't think they think the market's going to take off if they just wait till the new year. You know what I mean? So I think they're kind of adjusting a little bit faster this year, I think, is what I'm finding.
I still find like a little bit that like, I think this is why like real estate corrections also like take longer to sort of play out, right? Which is like some of the, not all, but some of the conversations that I've had with people is like, oh, listen, like, you go into like a listing presentation, you say, hey, here's your price. And, the seller goes, well, yeah, no, I think we want to start higher. So you go, okay, well, at the end of the day, you're the client, you have to make the decision. I can only give you my recommendation. And so they come on with this like higher price. Lo and behold, it sits there for 3 or 4 weeks. And then they go, okay, Steve, you know what? You were right. Let's drop it down to your suggestion. Well, the problem is that over those 3 to 4 weeks, the market's moved again. Mm-hmm. So like the new price is not my price that I suggested 4 weeks ago. It's a new price. And so what happens is you tend to see these sellers that kind of chase the market lower. And I do worry that there's going to be people that get caught up in that. I think it's inevitable because we saw it back in 2016-17 where people held on to some of these houses for 2 years before they finally sold at the bottom in 2018. And I do think there's going to be some people that again kind of get to just, it's so tough mentally, but you like in a market that's changing, you have to get out like in front of it. And it's so hard mentally for sellers to like, oh, I have to take less than like what I think I'm worth today, because like that's kind of like a moving target. Is really tough mentally. But I think the people that end up, getting out ahead, they end up taking a little bit less today for a number that looks better or looks pretty good 6 months from now.
Yeah, I mean, that's a phenomenon, the seller resistance that has even borne itself out in academic literature, right, John? That sticky price.
Oh yeah, that loss aversion.
The loss aversion, and I think there was a Nobel Prize awarded out of this kind of research that homeowners show a very interesting behavior on the reason why home prices don't tend to drop as quickly as in some other asset classes is because of that resistance, that stickiness, that, oh, wait,
Yeah, it's great. It's definitely like sellers out there. And like, whether I'm on the buy side or on the list side, you have these conversations and it's like, it's oh, we've been on the market for 2 months here. It's the fall, the market's just not that good. Let's take it off and let's try again in the spring. And it's like, okay, sure. But like, I don't know what the spring market's going to look like. I think so long as you have mortgage rates, in the sixes, I think it's going to be a challenging market. I wouldn't expect prices to change with 6% mortgage rates now, but like a lot of sellers will take that bet and say, well, historically, it's worked out time has been on our side. It's worked out very well historically that, next year is always going to be better. And so it'll be interesting to sort of see, because like I said, I don't know where next spring is going to be. I think it ultimately depends on the trajectory of mortgage rates. But I think for people that want to sell today in today's environment, you have to be aggressive and you have to get out in front of your competition, which is your neighbors, and you got to be priced sharper. And the stuff that's priced sharper, I think, John, and you could probably test this, is still moving. A decent house that's priced well is moving.
Yeah, I think that leads us. Sorry, John. That leads us right into interest rate corner. And Steve, you touched on this. So early September, the Bank of Canada held its rate at 5%. The next announcement is coming in late October. But right now we're seeing inflation and bond yields are on the rise. Many central bankers and other experts expect interest rates to stay higher for longer. So that would add to the pessimistic outlook for the market. What do you two think we're probably looking at in this fall with interest rates? Steve?
I'll let you go. I'll let Steve lead.
Everybody's pointing at everyone else.
Again, I don't know. People will probably bash me on here because I've truthfully been wrong over the last 12 months, but I think they're done. I think the bond market's doing the work for them, to be honest. I mean, the day they're recording this is Tuesday, October 3rd here. The last close on the 5-year bond was on Friday, so we had the long weekend. We're up basically 20 basis points over the weekend here. On a 5-year bond. I mean, that's not a normal move. And so I think the bond market's doing all the tightening for the Bank of Canada. And I think if you look at recent GDP numbers, they're horrible. And so I think that I think they're done. But I'm not something to say there's a imminent rate cut coming. But you hold rates at these levels, John, like we just talked about it, which is like the people that are transacting even today most of them still aren't on the new rate of 6.3, 6.4, whatever you want to call it. And so activity is just going to slow further here. I think there was a great chart someone posted like a couple of weeks ago, which is like the Bank of Canada puts out a chart or an index which shows like sort of the average mortgage rate that Canadian households have today. I think it's like 4.3%. Because the reality is like a lot of people that were like on fixed rates from 3 or 4 years ago are still on these low rates. But if you sort of average it out, we're at 4.3. Well, like I said, the market's in the 6s today. So there's still a lot more tightening to come, assuming that rates stay at these levels.
Yeah, I mean, I tend to agree a lot with Steve. I mean, I don't think it matters as much what the bank does next month. Like at the end of the day, I agree with Steve. I mean, the bond market's doing the work, and like rates have been ripping on fixed rates. I mean, that's been the biggest problem since June. When we think about why the market has cooled so quickly, it's not just the 50 basis points increase in June and July. It's that fixed rates have gone up by more than 125 basis points from the spring to now. Like in the spring of this year, you're getting fixed mortgages in the fours, right? Now everything's in the sixes. And that's had a bigger impact than the 50 basis points that the bank has increased. I mean, obviously that they're all kind of connected, but it's the fact that fixed rates have moved far higher than those 50 basis points that's impacting, I'd say, the market today. And I agree, as long as rates stay this high, it's going to be a very challenging fall. It's going to be a very challenging new year. I mean, we'll see how many people can afford buying a home when you're getting stress tested at 8.5% at these prices.
I do have a story for you.
Go for it.
I mean, these are just like anecdotal stories, right? Because I think like the anecdotes ultimately, I think they matter more. Like I think like as the market quickly. So I'm just looking here. So we had. Yeah, so I was chatting with one of my mortgage brokers last week, and he says, I said, oh, are you seeing any stress? You're having conversations with clients. I like to ask everybody like what they're seeing. He's giving me like one story, and it's not uncommon, but I just found it interesting. He was saying, oh yeah, I was chatting with a client the other week. The client calls me because they were on a variable rate mortgage. When they signed the contract, they bought a nice single family house in Vancouver here. And when they signed the mortgage, their monthly mortgage was $7,000 a month, and now they're paying $13,000. And it's like, well, what? How long can you hold that for, right? You go from the 7 to 13, and these, you got to pay that 13 with after tax income dollars. I think you hold on for a while. I think you hold on for 6 months, 12 months, maybe 18 months, but at some point, I think it becomes insurmountable. And so this just takes time to sort of filter through the market and the housing.
All right. Well, you guys are looking a bit glum. Should we? No, I mean, it isn't, it's not funny, actually. I think we are starting to see some signs of this. We did see an Bank of Canada chief, I think, say that prices are so high, home prices in Canada, that, further interest rates, it's hard to see that, that can even happen, that can be withstood. But if these rates stay elevated for even a bit longer, that in and of itself, as you guys are pointing out, could start to see result in that listing surge, the things that we haven't quite seen yet.
Mm-hmm.
And that's, of course, independent of other concerns like recession. So let's move on to our next topic, which is, Steve, you had a great post on LinkedIn just recently about the CMHC, the Canadian Mortgage Housing Corporation, updating its report. So now Canada needs about 3.5 million additional housing units by 2030 to restore affordability. But what the hell does that even mean, you asked? It means over the next 6 years, we need to average 583,000 housing completions per year. Over the past 5 years, we've averaged just over 200,000 completions per year. In other words, it's never going to happen, but we're going to try anyways because we have to. And governments are now ambitiously rolling out new measures. And I want to touch on some of those measures in more detail. But first, I want to just have you respond to, what motivated you again to post on this, and what is the biggest concern you have right now? And I think you're talking about how in this high interest rate environment, the impetus to build is really drying up. So,
yeah, I think like it's you hear all these like government policy measures coming out. Obviously, there's elections not too far away. Clearly, society is pulling apart here, and everyone's starting to point fingers and saying, "What are we going to do?" And so you're seeing all these governments coming out and say, "Okay, now we're going to fix housing. We just have to build all these units." And the reality is, it's like you can have all these like professors and everybody sort of pontificating in a room, but at the end of the day, I don't think you can pontificate as much as you want, but like the economics matter. And like, no, it seems like nobody really is like thinking about that, which is like, it's going to be impossible to ramp up like housing starts in any meaningful capacity with interest rates at these levels. I mean, like, it's just free markets deciding where they want to deploy capital. And the numbers were tight to begin with, and they're even tighter now. And so like you can remove GST, and like it'll move the needle a tiny little bit. But then, it's funny because then, the municipalities come in and they raise they raise taxes on development levies, development DCCs, development cost charges, and which basically ended up negating the benefit of the GST. So now the federal government's saying, oh, well, we're going to approve you for the Housing Accelerator Fund. But we're now going to pull those funds because you guys are raising DCCs to pay for, water treatment plants, sewage treatment upgrades, all that other stuff. And I think the reality is that, the economics matter. And so all these projections with CMHC and the federal government, like, I don't think they really matter, because I think what matters is economics. And I think in the end of the day, in the near term, chat about this on our show with Ben Rabideau, which was nothing matters other than 6% mortgage rates in the near term. And that's going to dictate, where the housing market goes in the near term. And it's going to dictate what happens with housing supply in the near term.
John, you've written extensively on this. Housing starts are, let's not use those academic terms, but the point is they are not as responsive in Ontario, and haven't been for a very long time. And there's a number of reasons, construction, labor supply shortage, and other reasons. But now the high interest rates are probably the biggest story. The financing of these projects, how many are being canceled, how many are being put on hold, and what is that going to mean?
Yeah, I mean, we're rolling over. And I think, Steve's right. It doesn't matter that we have a long-term supply demand imbalance issue, tension that's going to kind of impact house price over the long term. The short-term interest rates are going to dictate both what happens in the resale market and what happens in new housing construction. I mean, new housing construction slowing down largely because rates are so high. And that's just going to make things worse. And the one challenge, again, I mean, the one unfortunate thing we're seeing is, our federal government, I mean, to come up with a solution for a housing crisis, which is kind of what we have, that's impossible. I mean, because tripling the number of homes a country builds pretty much overnight when they're already kind of close to max capacity is never going to happen. Is one challenge. I mean, on the flip side, the reality is the feds, I mean, and even the opposition, I mean, Pierre, everyone's blaming the cities for this. I mean, and it's not really a city problem. Cities can't triple housing completions overnight. So it's going to be, again, a challenging market. I don't think many of these policies are going to have any impact in the near term because it's just a difficult environment to build in right now.
So you and Steve, I just wanted to say that you're both touching on an announcement from Trudeau's federal government to remove GST on purpose-built rentals. And so that's forthcoming. And Steve, I cut you off. I'm also wondering specifically what you think of that policy change and the impact it would have.
For sure. I don't think John nor I are negating like that we need more housing supply. That I think over a long horizon, we need it and will certainly help. But like I said, over the near term, I think that it's, we're putting the right policies in place today, but anyone looking for like a solution in the next, 3, 4, 5 years, I think is naive, which is, I think you could rezone the entire city today. And it's not going to get you necessarily a lot more housing starts. There's a lot of land we could rezone, but I don't think it's necessarily like a rezoning issue. I think it's the access to the trade people, and it's the cost of capital. And when you're getting paid, 6% to sort of sit on your hands, it just doesn't make a whole lot of sense for these developers.
Yeah. So what I'm hearing is long-standing issues, like the inability for us to do something about the construction sector, whether through temporary work, focus or whatever. This is a long-standing issue. They've never been able to scale up. Now we have higher interest rates. So these are conditions that are not ripe. I want to get one more reaction though to another government measure. This one just came out. The Ford's Ontario government has just announced that it will be introducing a new piece of legislation. So they had the Build Homes Faster Act. They're now going to be putting forward the Affordable Homes and Good Jobs Act. And part of this act is trying to change the definition of affordable housing. And the reason they want to do this is because if housing is deemed affordable, then the Ontario government is announcing that they will remove development charges or reduce them. So not only this seems bigger than just removing GST or HST, the province said the updated definition would more closely align with what appears in the provincial policy statement, which considers a home to be affordable if the purchase price is less than 30% of a low or moderate income household's annual income, or at least 10% below the average price of a resale home. Rental units are considered affordable if the cost is at or below the average market rent, or doesn't exceed 30% of a low or moderate income household's annual income. So, Steve, you did touch upon how development charges often mitigate or just kind of erase the gains made by any other measures. Does this kind of measure make you hopeful, or, you know?
I haven't followed along that one too closely. I mean, John's probably better to comment than I am.
Yeah, that was just announced yesterday, I think.
But listen, I mean, the private sector's not in the business of building housing that's below market. Okay. So the only people who are going to benefit from this, quite frankly, are the provinces and the feds if they decide to start investing in, you know, affordable housing, means tested housing, like stuff that is targeting a completely different group. And you know, that's where affordable housing generally is coming from. I mean, you might get some non-for-profits, for example, taking advantage, but that's on the margins. So, you know, I don't see that having much of an impact because, again, I think the province and the feds have abandoned building affordable housing. I mean, since the 90s, I think, and this is kind of one of the problems. So that's probably not going to have a huge impact. Going back to the HST or GST, I mean, one thing I think is important to think about is, you know, this actually may lead to more condos, but not necessarily like more total new housing units. What's probably going to happen, especially if the province removes sort of the provincial component of HST, is we're probably going to see more builders building purpose-built rentals and fewer condos, right? So it's kind of like in the 2000s, like we saw this run up in condo starts and it was like amazing, we're building more, but it sort of came at the expense of low rise. Like if you look at a 20-year chart of housing completions, condos are going up, single family homes, low rise are going down. And we're probably going to see a very similar trend between condos and purpose-built rentals. Rentals will probably increase and condos will probably decline as the numbers don't make sense for mom and pop investors. And so because you're getting that big tax advantage with the HST, right?
Right. So you're always saying like these measures, they're not expanding the units. They're not accelerating or amplifying the units completely. They just tend to divert again from one to another and then, you know, and back. And exactly. And that puzzle hasn't really been convincingly thought out. I wanted to actually point out another article that just came out, which led me to something else that you're both touching on. So let's say you are able to build more. This is interesting. Urban Nation, along with rentals.ca, released their August National Rental Report, which showed rents in Canada had increased 9.6% annually to reach another record high of $2,100 a month. That is high if you consider that's a Canada-wide average. Mm-hmm. This occurred despite rental apartment completions reaching their highest level in decades. So this is interesting because this is a bit different. This suggests some building is happening. But despite rental apartment completions in Canada over the past 12 months reaching their highest levels since the 1970s, rent growth has remained exceptionally strong. This can be attributed to the country's record high population growth and sharp deterioration in home ownership affordability. So, Steve, you've already touched upon fiscal at odds with monetary policy, but there's also that one other federal lever: population demand. And does it, you know, I'm even wondering if CMHC's latest numbers included projected population increases, or is that,
Yeah, they did. It's just hard because like I feel like, and we got like what do we get? Like 150,000 person revision to our immigration figures like last month. So it's like
Yeah.
our own stats agency doesn't seem to know how many people are coming into this country. So it obviously makes it very difficult for CMHC to make projections and municipalities to figure out how much housing to approve. The one thing I'd sort of add to that, it's really quite rich when the immigration minister in Canada is out there saying, well, we need these immigrants because they're the ones that are going to build more housing. But there was actually a research report from CIBC's Benjamin Tal that showed over the last, I think, 5 to 8 years, the percentage of people coming into this country that are immigrating here, the percentage of them that are entering into the construction workforce has actually been declining. So, it's not, you need to see that number not decline. It needs to go in the other direction if you want to say, okay, we're bringing these people in because they're actually going to come and they're going to build the housing. But it's like, no, in fact, that percentage is declining. So I think it's just a complete misnomer. A lucrative asset, as he calls it, for these private institutions. But I think that's kind of the gist of it. So
I'm going to return to the lucrative asset discussion in a second. I think he was referring to foreign students specifically, but let's come back to that. John, again, you posted about Canada's population outstripping G7 countries. I forget the latest numbers you're posting.
It's not even G7 countries. I think we're actually among the fastest in the world.
Oh, I know we're the fastest in the world. I know we're beating countries in Africa and Asia, but among but we're certainly the fastest in the G7.
Probably G20 even. Yeah, yes, for sure.
Yeah.
So, and I think our growth rate is over 3% per year, I think, with the latest numbers. And for context, for the average person who kind of doesn't know what that means, I mean, historically, we're probably, and most of the G7 are probably just below 1%, population growth rate. And this is the fastest we've grown since the 50s, right? And obviously, again, even those growth rates in the 50s were quite a bit different because a lot of that was driven by the baby boom. You know what I mean? And where higher population's growing, obviously, impacts sort of how much housing you need because, if a family has a baby, they don't necessarily need a new home. Obviously, immigration and foreign students like that obviously is going to put more demand and stress on housing because they need new housing. But anyhow, yeah, so the fastest population growth rate since the 50s, and that's the challenge we're having, I think, today in today's housing market.
Just to chime in here, I'm kind of curious your thoughts, but I get worried when I hear people in the industry, telling people that like, well, look how much we're immigrating, we're not building enough housing, rents can only go in one direction, which is up. And you see people making investment purchases, condos or whatever, as an investor, projecting these infinitely higher rents. And I would still caution people that, while that's true over a long period of time, it doesn't mean that rents actually can't fall in the near term, as we saw during the pandemic, right? Because what happens is you get job losses in this country, which I think are coming. Household formation basically falls apart, right? So people will leave their studio condo in downtown Toronto that they're paying $2,500 a month for, and they go back and they move in with mom and dad because they lost their job, or they're trying to save money. They've gone from full-time to part-time. And so, we saw that during the pandemic. And so I would just caution people, and it's the same thing on the immigration side, right? I mean, if the economy really starts to stink, a lot of these temporary residents will leave and they will go back home, albeit maybe temporary. But I think that I would just put that in the back of people's heads that rents are going up right now, but I wouldn't project that moving forward into assuming that it's going to continue at its current rate.
Yeah, I mean, there's a huge rents, unlike home prices, rents are like truly constrained by local incomes, right? And I say truly because home prices are different, because home prices are not 100% constrained because you can have more capital. Your family can give you capital, right? If interest rates drop, you can borrow more relative to your income in a lower rate environment than in a higher rate environment, right? So it's not, whereas rents is just like a fixed payment. You know what I mean? You can't leverage it. You can't have as, they're truly constrained by income. So yeah, there's going to be a ceiling to how high they can go. And I agree 100% with Steve that a lot of people, even buying pre-con today, are very optimistic about where rents are going. But I don't know. It's going to be a challenging market, I think, in the next few years for rents.
Well, I think we can start to put some more concrete details on what Steve's talking about in terms of things can change right now. So last month, interestingly enough, our roundtable, we had a really robust discussion around foreign students and how Canada's seemingly second Ponzi scheme had become education degrees, a lot of questionable expansion of educational programs across, especially Ontario and parts of BC, without ensuring adequate housing for all of these students coming in. Some of that can be said for other temporary workers as well, I'm sure. Now, that we were talking about put a lot of pressure on the rental market, in addition to victimizing foreign students who couldn't get jobs, and we discussed a whole host of issues. Now, it was such a long discussion that we got a really informed message to our YouTube channel, from an international student's mother saying, hey, let's not make international students a scapegoat. And I just want to make clear that my response, which, because it's important to me. So, as I said, this issue is very close to my heart, and all of us at Move Smartly, and most, if not all of our guests, have, some kind of study or, foreign student or immigration story in our own immediate life stories in our family. So especially if you are in Toronto or Vancouver, where over 75% of Canadians have that kind of background. I know I'm one of them. My dad's, the foothold of my family into North America was my dad studying engineering in Detroit at Wayne State University. So certainly this is not about targeting anybody, but more about what happens if you just let so many people in, or such a big expansion of the foreign education industry without any coordination, without any checks and balances. What can happen? And what we saw is crazy pressure, even on secondary rental markets, outside of Toronto, in these cities where these institutions were located. What a change in 1 month's time. Because in 1 month's time, Canada and India got into a little bit of a spat. I'm not sure if any of you have noticed. So, and we say real estate's not political and we don't like to mix politics. We have to. Over an incident which is now still being investigated, the Canadian government is leveling the very serious accusation against the Indian government that potentially an assassination of a citizen of Canada has taken place on Canadian soil with the involvement of the Indian government, a very serious charge. We haven't heard all the details. Apparently, this is based on intelligence that's being shared between Canadian and US authorities. So I think, our opinions aside about how our federal government has handled this and how it should, that's probably more in the foreign policy arena. But the outflow or the impact of this, funnily enough, comes back to those foreign students that Steve was alluding to. Our immigration minister recently calling, what was it, Steve, a valuable asset?
Very lucrative assets.
Very lucrative assets. This is how we're talking about foreign students now. Interestingly enough, Canadian government stats do say that in 2022, international students contributed over 22.3 billion per year to the Canadian economy, greater than exports of auto parts, lumber, or aircraft. Now, as a result of this political incident between India and Canada, it's ongoing. The Indian government is not issuing visas for Canadians to go to India, and is actively making it difficult, if not impossible, for Indian students to come to Canada to study. Apparently, John, you were talking to some people. Also, there is some other measures like trying to make it hard to basically convert your money into Canadian dollars to finance that education in Canada. And the impact of this shouldn't be understated. About 10 years ago, Australia had an incident in which several Indian foreign students were the victim of racist physical assaults in different parts of the country. the opinion in India that Australia had become an unsafe country to go to study in was so pronounced that they could measure in numbers a diversion to the UK and Canada, which are the comparable markets. So, I don't think this is a little thing that's happening. I'm not going to joke about such a serious situation to say, is this a really creative way to stem foreign student numbers? I mean,
Yeah.
it's terrible, but.
I don't know how this is gonna play out, but yeah, we might see are we gonna see a slowdown? I mean, I don't know. These are obviously probably over my head when thinking about how it's gonna impact, but I mean, yeah, we might see a decline. I mean, again, who knows how that's gonna unfold over the next 12 months. And we're gonna probably know by September anyways, like next September.
Yeah, and Steve, we're talking about the rental market, and we were talking about the rental market being impacted by foreign students. If the number one source of these students are not going to come in at high numbers. Now, remember, this has now been implemented. We have to presume that people hold their visas and there's a certain number that are already coming. But what do you think, Steve? Just on the, bare facts of it.
I think it's just like acknowledging potential risks that can change your outlook, right? I mean, I don't think neither of us have a crystal ball of what the future is going to look like, but I think we just have to. I think you always have to be cognizant of like what's the risks. Where could I potentially be getting it wrong? And so this is just something else I would just kind of throw into the loop there and just assess it and say, okay, well, can we and should we be extrapolating that we're going to continue to grow at 1 million people a year? In perpetuity, I highly doubt it. And so, like I said, I think it would just be cognizant of looking at rent growth. I think Vancouver and Toronto has been, historically a market that grows rents significantly. As someone that's actively investing in Calgary, you can tell you that market didn't move. Rent growth actually rents fell for they fell and they were flat to down for 5 years because the economy ultimately went through a slump and there was less immigration into that province as a result. And so I think that's just another headwind that I would just kind of caution people that everyone's just looking at and saying, oh, the rental market, you got to buy real estate because the rental market's so bad, which is again, I think it's just people just need to be aware of the risks. And so that's kind of how I'd look at it.
Yeah. And a risk emerged literally in a couple of weeks that we had no idea would be on our radar. So, I think that just totally, I think, emphasizes the point that you're making. And of course, these are real human beings involved on all sides. And we hope, I hope that everything will be resolved in a way that we would want to see, in a rule of law way, transparency on all sides. Obviously, people are not part of lucrative assets in the middle of these kind of disputes.
I can't believe he called foreign students.
Is there a speech writing labor shortage just across the country?
It's shocking. It's shocking.
I'm wondering.
I don't know how these guys are. Yeah, it's crazy. I mean, 2025 feels like really, really far away. But
yeah.
Be a
bumpy. Sorry, Steve?
It's going to be a bumpy ride between now and then. I don't know. I'm just looking at it and saying, one of the things I've been really factoring in lately is again, we try to keep the politics out of it. You can't not I just look at it and say, okay, if housing is going to be households are getting squeezed right now, right? Interest rates, even if you don't have a mortgage, right? Let's just say you got, a line of credit or a credit card or whatever, people are really feeling the stress right now. And so I look at it and say, man, if we stay at these levels of interest rates for a prolonged period of time, let's call it the next 12 months, I think we're going to see more and more financial strain. And what does that do to the politics in this country? Not just at a federal level, but at a provincial level, at a municipal level. I just think it's going to be a really, really bumpy ride here for the next 18 months.
All right. Well, I feel it. I'm feeling it in the room, and it is what it is. I'm wondering, before we sign off, from each of you, is there something specifically, either a number or a metric or something that you're going to keep, the closest eye on? something that you feel is going to give you a real idea of what the magnitude in shift might be in the market, if there will be one, and in which direction?
Good question. John, go first.
I don't know. I think probably, inflation and bond yields, I think are probably the most important right now. I think that's going to, largely dictate, how quickly rates fall, if they do fall, when they might fall. Because again, I think as long as inflation stays high, rates stay high, if obviously bond yields continue to stay elevated, that's going to have a huge impact. So I'd say those are probably the couple of main things. I mean, obvious things, at least for me, that stand out that I think are going to be pretty key.
Yeah, I think for me, it's new listings. I think that for Greater Vancouver, I think Toronto is pretty much the same, but like for a good chunk of this year, we've seen new listings grossly below long-term averages. In many cases for Vancouver, 20-year lows for I think four of the months this year, and that's really helped support prices. And now, we'll see. But I mean, September is only 1 month, right? But 1 month where the listings finally came in, actually 5% above the long-term average. So new listings finally have started to kind of normalize. And I think it's no question in my mind that demand is going to remain challenged with these mortgage rates. And so the big variable is if new listings can sustain themselves at long-term averages, that's going to allow inventory to build quite quickly. And I think that as that inventory builds, it just puts more pressure on prices.
Right. So a few targets that we can circle back to next month and really measure you on. Not measure you on, see where we're at. I think that gives us something to think about as we head into the fall market. So thank you, as always, for your great insights. I thought we had some great numbers being shared there too. I can be reached at editor@movesmartly.com by email. We are on X Twitter at @MoveSmartly. John is on X Twitter. I'm calling it X Twitter. Clever. At John Pizzalis.
I think it's always going to be Twitter.
No, it's X Twitter. It was the thing that was Twitter.
All right.
So, and Steve is at Steve Saretsky. And we look forward to just keep your questions coming. We have noticed an uptick in consumer questions about specific situations. This isn't quite, we can't get to really detailed questions, but if you do have some questions for our show that you'd like to hear John and Steve on, please send them in because I think this is a time where a lot of different questions are sort of, permeating in people's minds.
And I'll say this is like, if you have very specific questions about your personal situations, whether that be mortgage rates, pre-sales you got to close on or don't have to close on, you can feel free to email me personally. I'm happy to take time and try to help people out. I know I get people from different parts of the country asking questions, and while I can't get into market specifics of that neighborhood, I'm happy to sort of provide an input where I can. So
great, Steve. And give your email.
It's steve@stevesaretsky.com.
And that reminds me, on our channel here at Move Smartly, I pose a very specific consumer questions to John every month in our The Situation segment. So you can also keep those more detailed questions coming as well for consideration on that segment. And you can send those to you.
Yeah, I'm at Ask John at Move Smartly, and I echo Steve. I mean, I'm sure Steve's in the same situation. I mean, we've been spending a lot of time just chatting with people. I mean, quite frankly, just difficult situations, stressful situations, not even about selling or buying. It's just people getting, advice because they're stretched. They're not sure what to do. So I agree. I'm happy to connect with people just like Steve. I mean, especially in these times when, people just want some independent advice.
Yeah. So certainly that pinch of that high interest rate, it is now rolling through. They say it takes time, but, people are really feeling it. So we'll continue to track those issues for next month. So thank you so much. Thanks to all our viewers on YouTube, and thanks to our podcast listeners. We've seen an uptick. Please keep listening to us. If you enjoy our podcast, give us a review on Apple Podcasts. It always helps get this word out about the show. So thanks again. See you next month.